Electric cars are zooming into the future, but there's a twist in the tale. People all over the world, especially in the US, are buying more and more electric vehicles. In fact, folks spent a whopping $400 billion on them in just 1 year. Car companies are super excited too, pouring in over $600 billion for making even more electric cars. But hold on, there's an error on this electric journey. These shiny new EVs are not racing out of the dealerships as fast as before. It's like they're taking a long pit stop. So what's going on here? And why are these electric dreams slowing down? Electric car slowdown. EVs are stacking up in dealerships, and the reasons are multifaceted. The anticipated growth of EVs has not matched the optimistic projections set by officials and automakers. A few years back, the surge in EV popularity was driven by early adopters and tech enthusiasts. These high-tech vehicles were seen as the future of transportation, with governments and manufacturers alike expecting a swift and significant shift to electric. The initial boom in EV sales was impressive, with nearly 100% year-over-year growth. This led to ambitious goals, such as the expectation that 2/3 of new cars would be electric by 2032. However, this forecast was not grounded in comprehensive research, but rather on the momentum of the early days. As the market expanded beyond early adopters, the growth began to taper off. Last year, the EV market share approached 8%, a figure that falls short of earlier expectations. Now in 2024, the slowdown continues. January saw a year-over-year growth of just 40%, a stark contrast to the previous year's near-doubling figures. Despite this, carmakers are producing EVs at an unprecedented rate. This disconnect between production and actual demand has led to an oversupply, leaving dealers with lots brimming with unsold electric cars. The challenges faced by dealers are significant. They are the vital link between manufacturers and consumers, yet they find themselves with a surplus of products that customers are hesitant to purchase in large numbers. This hesitancy could be attributed to various factors, including the availability of charging infrastructure, the cost of EVs compared to traditional vehicles, and consumer uncertainty about the technology. The aggressive push from both established automotive brands and new startups has not translated into the expected sales volumes. This imbalance has resulted in a glut of EVs on dealership lots, a situation that poses financial risks for dealers who rely on inventory turnover to sustain their businesses. The automotive industry is at a crossroads, with the transition to electric vehicles proving more complex than initially thought. While the long-term trend may still favor electric, the current state of the market reflects a mismatch between the vision of a predominantly electric future and the reality of consumer adoption rates. Dealers caught in the middle must navigate these challenges as they adapt to the evolving landscape of the automotive industry. The coming years will be crucial in determining whether the growth of EVs can accelerate to meet the lofty goals set by proponents of electric transportation. Dealership dilemma. Dealerships are overstocked, and the average market supply now exceeds 100 days. This surplus is a clear indicator that EVs are not selling as quickly as anticipated. In response, some automakers have reduced their production targets for the year. A notable example is the all-electric F-150, whose production was slashed to half of the original plan for this year. Despite slow sales, other carmakers continue to produce new EVs. This strategy is a precautionary measure due to the unpredictable nature of the EV production process. Supply chain disruptions, particularly in raw materials and battery procurement, coupled with less than ideal production lines, compel manufacturers to produce more EVs than the market demands. This overproduction is a hedge against potential production halts. Dealers bear the brunt of these industry challenges. They are stuck with an inventory that moves slowly, affecting their financial stability and operational efficiency. The end of the early adopter phase has brought another issue to the forefront: pricing. The general population is reluctant to pay premium prices for EVs solely for the benefit of zero emissions. In 2023, the average car purchase was around $48,000, while EVs were priced near $60,000. This price gap is significant, especially considering the higher interest rates on loans, which add to the financial burden for new car buyers. Luxury EVs are the slowest to sell, with the highest market day supply. For instance, the Porsche Taycan, with a starting price of approximately $92,000, often sells for six figures and has a market day supply of 239. It is followed by other luxury models like the Mercedes EQS and EQS SUV. Even mainstream EVs are accumulating in lots. The Mustang Mach-E, for example, has a market day supply of over 200, with more than 17,000 units unsold across the US. Established models like the Nissan Leaf also struggle, with a market day supply of 161, well above the average. The high prices of EVs are a significant factor in their slow sales, but they are not the only reason. The transition from early adopters to the broader consumer base has not been as smooth as expected. Challenges of EV adoption. One of the primary concerns is the range anxiety associated with long journeys. While EVs offer an eco-friendly alternative for short commutes, their limited range of just over 300 miles on a single charge poses challenges for longer trips. This limitation often necessitates the ownership of an additional vehicle with an internal combustion engine or ICE for many EV owners, as relying solely on an EV is currently impractical for varied travel needs. The charging infrastructure is another critical issue that hampers the widespread acceptance of EVs. The current network of charging stations is insufficient, even in urban areas known for their technological advancements. The scarcity of fast chargers adds to the inconvenience, as standard chargers require significantly more time to recharge the vehicle's battery. This situation is compounded by the reliability of the charging stations. A survey by J.D. Power highlighted that 1 in 5 charging attempts failed due to various issues, such as malfunctioning payment systems, broken charging cords, and software glitches. In regions like the San Francisco Bay Area, only 72.5% of public chargers were operational, indicating that the problem extends beyond the quantity of chargers to include the quality of the charging experience. The economic aspect of EVs cannot be overlooked. High initial costs deter potential buyers who are also considering the practicality of owning an EV. The total cost of ownership includes not just the purchase price, but also the expenses related to charging, maintenance, and the potential need for a secondary vehicle. These factors contribute to the hesitation among consumers when contemplating an EV purchase, leading to a surplus of EVs on dealership lots. The industry must address the concerns related to range, charging infrastructure, and cost to make EVs a viable option for the average consumer. Only then can we expect a substantial shift in public perception and a corresponding increase in EV adoption rates. The journey towards a fully electric future is ongoing, and it requires concerted efforts from manufacturers, policymakers, and consumers alike to overcome the obstacles and realize the full potential of electric mobility. Consumer experience. Recent studies in consumer experiences suggest that the road to an all-electric future may be bumpier than anticipated. A report by Consumer Reports involving over 300,000 vehicles produced up to 2023 indicates that EVs are 80% more likely to encounter problems than their gasoline counterparts. This revelation contradicts the prevailing belief that EVs, with their fewer moving parts, would naturally be more reliable and require less maintenance. Instead, new owners are facing a myriad of issues, particularly with batteries and charging systems, which are fundamental to the operation of EVs. Moreover, the integration of advanced infotainment systems and digital controls has introduced additional complexities, leading to malfunctions and frustrations for users. The transition to EVs also demands a significant shift in lifestyle. Charging an EV is not as straightforward as refueling a gasoline car. It requires careful planning and a considerable amount of time. Maintenance, too, is evolving, with software updates becoming as critical as mechanical repairs. Dealerships are already grappling with software-related defects, and concerns loom over the post-warranty period when owners might face steep repair costs, especially for battery replacements. The financial implications of owning an EV extend beyond the purchase price. Despite government incentives, EVs remain more expensive than gasoline vehicles, and this cost disparity is exacerbated by higher insurance premiums and rapid depreciation rates. These economic factors contribute to consumer hesitation, leaving many EVs unsold on dealership lots. In light of these challenges, it is clear that both automakers and governments must address the reliability and lifestyle changes associated with EVs to accelerate their adoption. Until then, the vision of a fully electric future remains a work in progress, with potential buyers weighing the benefits against the drawbacks of this transformative technology. Now, what's your opinion on this? Let us know whatever you think about this in the comment section below. Also, make sure to like this video and subscribe to the channel for more upcoming content. Until then, keep exploring.